I'd love for you to dive into, like, you also get life insurance, right?
You get, yeah. I mean, it's beyond that. Like, how old are you again?
I'm 32. And
Okay, so you're
for
32.
full transparency, I do have 3 of these policies. So like, I understand them. I get them. I love them. I don't even look at them and I'm like, oh yeah. Like you even reminded me when we met, I was like, hey, I have this policy. And you're like, well, you could borrow against that for your next property. I was like, oh yeah, I forgot about that.
Oh yeah, there you go. It's awesome. Well, so think about it this way. Like, I don't know who your policies are with. It doesn't really matter. But here's the deal. And you probably don't even know this, like, because most agents are not educating their clients about this. But you have life insurance, which is great, right? Like, it's a life insurance policy. So you have it there. So your wife is taken care of, whatever. I always kind of say, this is a self-completing plan. Like, what you want to happen will happen when you want it to happen, whether you're here to see it or not, right? Like, so if I save money in a savings account, I think about, what do I want my wife and my 3 kids, what do I want their life to look like? If I'm saving in a savings account and I have something tragic happen to me, well, they have whatever is in the savings account. If I'm saving in a whole life policy, that policy on a cash basis over a 7 to 10 year period is going to beat my bank account. And if something tragic happens to me, like, like the financial goals that I have automatically self-complete. Everything that I'm saving for and working towards completes itself, right? So that's good. But here's the other thing. I always kind of say, you can't solve long-term problems with short-term thinking. And one of the other things that saving inside of a whole life insurance policy and utilizing it as a banking alternative works for you is that you have living benefits. So if you become critically or terminally ill, you get diagnosed with a cancer or something of that nature. I don't know about you, but I'm super into like alternative treatment. I share the story. My father-in-law was diagnosed with stage 4 pancreatic cancer and given 3 months to live on November 4th of 2020. And I mean, like, literally the doctors and the oncologists were like, well, we may be able to get him to a year, but his quality of life is going to be horrible, blah, 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 blah. And my wife and I were like, no, screw that. Like, we're not taking that as an answer. Well, like, maybe we don't succeed, but we're going to fight like hell. And so because we had access, we're policy loans that you can access for living benefits on a tax-free basis. You can accelerate the death benefit and use it for alternative medical treatments. So, you know, multiple 6 figures, we're talking over 200 grand in alternative medical treatments. My father-in-law is still playing golf 4 times a week, almost 2 years later.
That's awesome.
Right? If we had listened to the traditional Western world medical system, he'd be dead.
Wow.
And he'd probably been killed by the medical treatment that was trying to cure the cancer.
Funded by this policy, or saying it could have funded if he had had
No, it funded by the policy.
Funded by the policy. That's amazing.
All medical treatments paid by the acceleration of the death benefit.
Wow.
I've been talking a lot about this. So like you and I right now, I'm 43, you're 32. We both, like, it's going to be a while, hopefully, before we have to worry about that. But let's face it, at some point in time, you're going to get older. I'm going to get older. We're going to have the need for this stuff. We don't want to buy long-term care insurance and all these different things right now because it's like, you know, like, it's hard to find the value in it. That whole industry is like super volatile. And so having it as an extra kind of ancillary benefit in your policy is just icing on the cake. It's going to be there. Whether you think you need it now or not, the odds are you're going to need it during your lifetime. That's just statistics. And so it's super powerful. That's why I always call it saving in a whole life policy. It's like a savings account at a bank on steroids, because you're going to have all that. You're going to get about 10x return compared to traditional long-term savings rates in a bank. And you're going to get these other benefits. And when you break it down, I always kind of say to people, it's like, I don't tell anybody what they should or shouldn't do. I just say you should align your money with your values and beliefs. And so what I would ask you first is, do you believe you need an emergency fund? Most people will say, yes, I need an emergency fund. Then I would say, would you like to have an opportunity fund? So during market cycles, if you found any opportunity, like Dominican Republic, like any kind of investment in a market down cycle, that's when people get wealthy. You know, would you like an opportunity fund? Well, yeah, I think I would. All right. Where are you going to save that money? Let's talk about where you have guarantees, liquidity, all these things. And when you start backing out, like, why you want this or like what you want your money to do for you, you start to realize, like, there's no other asset that will do for you what this will do. It becomes a no-brainer.
Yeah, the reason I got my policies was not, you know, I realized I've actually never heard someone describe these as savings versus investing, because most of the guys that pitch me on it are like, they try to pitch it as an investment, and I'm an investor, so I looked at it from that way and was like, I'm not gonna get rich. This is not gonna produce that 40% return, the types of returns you're talking about in DR, but this is gonna give me some. I like to free myself to invest more aggressively. And this provided the foundation so I could invest aggressively, I should say. And then something else that I think I told you this when we met, I was like, something else that kind of got me is because I was young when I first had my first one. I was like 8-9 years ago. So I was, 20s. And I was like, life insurance? Like, life insurance isn't that important. But he basically said, this is kind of how it was presented to me. He said, look, man, these are guaranteed payout policies. So as long as, you don't run this thing completely dry, this thing's guaranteed to pay out the death benefit when you die. And he's like, that's kind of like a spend all your money while you're alive card. And I was like, what do you mean? And he's like, because think about it. If you know you're going to leave your heirs a couple $1 million, obviously, however big the policy is, then like, you don't have to worry about like saving for them, because as soon as you die, they're going to get the millions of dollars. Like, you can then like spend more while you're alive, and like you could use that for investments. You could do that to enjoy your life. And I just remember thinking about that and being like, oh, that's kind of a cool way to think about it.
It's true.
Present it that way, but I thought it was an interesting. Could you talk a little bit about how these policies get to a point where they eventually could self-fund themselves, or like you can put money in for a certain, at least, I mean, maybe if I'm misunderstanding it, please correct me, but from my understanding, you can fund them for a certain period of time, and then if something happens or you don't want to fund it anymore, you can stop. And it still continues to grow, albeit maybe not as fast, but it does continue to grow. Could you speak to that a little bit?
Yeah, 100%. There's different features inside of the policy. So when you buy a whole life policy with a participating mutually held life insurance company, you basically are the equivalent of a shareholder of a publicly traded company. So you get paid dividends participating in the profits of the company. So they pay out dividends to the policyholders. The whole life policyholders are the shareholders of the company. With a mutual company. And so when they pay these dividends every single year and they go into your policy, obviously they're directly correlated to the value of the policy. And so eventually what will happen is you'll see, and the way that we design them, typically it's between year 7 and 11 that this happens, that the dividend payout will be higher than your premium amount. So what can happen is you can say, all right, as soon as the dividend payout equals my premium, you can stop. It'll self-fund itself. You use the dividend to pay the premium and you're good to go.
Wow.
Like you don't, I would say, I always kind of tell you, like, once you hit year 7 in these policies, you're never going to want to stop putting money into it, because you're going to look at like the efficiency of what every dollar is doing for you. The most inefficient periods of time with utilizing this banking strategy with a whole life policy is the first 7 years. Really, the first 3 to 4 years is the most inefficient, but that's where you got to think long term. Like, you're investing in it for a long strategy, and if you start looking at it for the first 2 to 3, 4 years, you're going to be like, it's kind of a wash. I don't know if it's worth it. But then you start stretching that out and looking 7, 10, 15, 20 years, you're like, holy crap, like this is huge. That's why, like, one of my favorite phrases, you don't serve long-term problems with short-term thinking. It's like, this is really, really it's like a secure leverage strategy is what it is. Like, imagine you can create leverage with almost no risk, but it just takes time to build that.